to the Capital Discussions Roundtable. We have a guest, Mark Sebastian from Option Pit. Before we get started, a quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And as it says in the yellow, this is for educational purposes only. So with that, I'll turn the presenter over to you, Mark. And for those of you who don't know, Mark and I go back a number of years, and it's nice to get in touch with Mark again, and first time on the roundtable. A lot of people at Capital Discussions knew Mark from the Sheridan community, so welcome back in a sense, Mark, and glad to have you here.
Yeah, glad to be here. All right, where do I lost my screen share piece. Where is that?
If you're on Windows, you can go Control-Alt-D, like Delta, and that's your screen too.
All right, cool. All right, are you guys seeing my screen?
It's loading. There we go. I see it now.
All right. All right. Good to see everybody. Yeah, you know, I was kind of happy Tom invited me out, and I wasn't exactly sure. You know, when he said Traders Roundtable, and you know, these are kind of the topics we wanted to discuss. I just wanted to, you know, I had some different pieces that came to my mind, but you know, so all I'm going to do, I'm going to talk for, you know, 20, 25 minutes, maybe half an hour, and then I'll field questions. And, you know, as you've got questions, ask me anything you want. But we're here to talk about two things, the concept of units and the concept of reverse Harvey. So I'm going to start with, and really it all starts with the same idea, all right, risk. The number one piece of you know, the number one thing that I say to people all the time is first off, the best way to have great risk control is to be in great trades. All right, that's number one. All right, so if you don't know how to recognize a good trade from a bad trade, you don't know how to manage. It doesn't matter whether you're going to be able to manage risk or not. You'll lose money. All right, and that's just the way it is. Then the number two one is proper risk control. And risk control comes in all facets, and really every decision has a dollar sign is the way I kind of think about it. And you know, one of the things that I really ignore that most people are obsessed with is commissions. Obviously, I fight to get as low a commission as I possibly can. I will do anything I can to get that commission as low as possible. But outside of that, when it comes to my trading, I never consider commissions, ever. All right? And I want to discuss that. That's kind of the first piece to this whole thing. If you're trading and you're thinking, oh, I don't want to pay Thinkorswim or LiveVol or whomever the 75 cents or 65 cents, you are doing it wrong. All right, that is a quick way to be penny wise and pound foolish. Get your commissions as low as possible, and then be done with it. All right, and then revisit it with your brokerage firm. Never allow it to really make a decision for you. And this is where the concept of units comes into play. And what is you know, there are kind of three major types of options, all right? There's at-the-money options, there are out-of-the-money options, and there are units. And you're saying to me, Mark, but what about in-the-money options? In-the-money options are just out-of-the-money options with a bunch of delta, okay? The premium is the same on each strike, so the way we've always viewed this stuff is that everything's kind of an out-of-the-money option, or an at-the-money, or a unit. So let's separate these into pieces. A at the money option is going to be somewhere between a 40 and a 60 delta. Anywhere in that range, 41 to 59. Generally speaking, that's kind of an at the money option. All right, so and those are the options that are going to trade the most. They're most liquid. They're really the best sense of where volatility is. You know, the at the money space is really where volatility is determined, and that's the space where volatility is most likely to be correct. All right, and then the next piece is out of the money. All right, and out of the money is going to be your deltas that are kind of 41 down to about 5. All right, now, obviously there's a big difference between a meaty out of the money option and a kind of less meaty out of the money option, but those are still, you know, the key is that those options, all the way down to about a 5 or a 10 delta, all right, they are going to move with the underlying. The volatility is going to move with the underlying, and they have somewhat predictable volatility behavior. That's the key to understanding each of these. Is at the money is where volatility is really set. Then out of the money is where volatility behavior, you know, it kind of scales the volatility behavior. The further away you move from the money, the less these things move alike. All right. If, you know, I love using paint to do demos. So if you think about volatility, all right, let's say that, let's say, you know, this is at the money volatility, all right, and calls are going to look like this, and puts are going to look like this. Now I'm going to use a oops, that's not what I wanted. I want a different brush. Let's keep that 2. All right. So if this is at the money, and your puts are kind of like that, and your calls are kind of trailing off this way, all right? So the question is, if this guy moves up to here, how is the curve going to behave? All right, what's going to happen to puts? What's going to happen to calls? And the nearer the money we are, the more predictable that behavior is. All right, it could flatten. It could steepen. You know, if you look at how volatility moved on this latest incident, I think it's very, very clear that the whole curve can shift. But even so, all of this is stuff that we can somewhat model, all the way out to about the 5 or 10 delta. I can do a decent job of modeling movement. Then, once you get outside that, you're in this weird, murky territory. Well, you're in this weird, murky territory where, you know, we're not sure what's going to happen, and the behavior can be entirely unpredictable. Oh, so this is strike price.
The x-axis and the y-axis of this graph.
The y-axis is vol. The x-axis is strike price. All right. So then in the outermost regions of the curve, you know, out in here at the end of every curve, you've got these little cheapy things. And you're never really sure what they're going to do in a situation, all right, and whether they're going to come into play. But generally speaking, and this is especially true of puts, you know, you ever cracked a whip, Tom?
Oh, yeah, sure.
All right. Now, do we all know what the sound of a cracking whip is?
I would assume so.
All right. Well, I want to make sure everybody's aware. All right. Does everybody know what the sound of a cracking whip is? What is it? No, not the, what is that sound? Yeah, it's the sound barrier being broken. All right. Now, this is coming from an arm. Yeah, it's a sonic boom. All right. So this is coming from an arm movement that was fast, but I would never say crazy. And the way I want you to think of really, really far out of the money options is very much like the tip of a whip. They can move so fast and so explosively that they basically create a sonic boom. And that is why one has to understand how to trade and manage units. All right? A unit is a cheap option. All right? In the SPX, that's going to be an option that's worth, less than $5 or $4. All right? At a minimum, really less than $2.50. And in a $100 stocks, that's going to be options worth less than a quarter. And in $20 stocks, that's going to be options worth less than 10 cents. Okay? And they can absolutely explode. So let me show you what I mean. All right, so this is General Electric, $25 stock. And it's got 3 days to expire. It's trading $25.30. All right, and so now what I want to do is look at these options. All right, so let's just look at the 26 strike. And when I look here, the 26 strike is worth, it's worth, call it 14 cents. And it's decaying a penny a day. All right, now, what do you know? The next week up is worth 7 cents. Makes sense. Still decaying a penny a day. But if you look a week forward, we have an option worth a penny and a half. Really, let's call it 2 cents. It's still decaying a penny a day. So somewhere in this area, something changed. Here to here. Decay began to slow down. All right, and I can show you better, even greater examples of this with high dollar stocks. All right. Get that out of the way. So if we pull up more strikes on Apple. All right. I'm going to find a worthless option. What does it say with more decimal points? It's certainly, I don't know. My guess is probably greater than 1. The point is that theta breaks. All right, I can show you some clear, we're going to look at some clear examples. So, like, look at the SEP 109 puts are $7 out of the money. Let's look at this whole curve here. All right, so this is the put curve on the weekly that's going to expire this week. And then let's look at how those strikes look. All right, we go down to 101. So I'll pull the 101 right there. So the 101 puts that expire in 3 days are worth 2 cents. Okay? Look at the theta on the 101 puts. They're worth 14 cents, and they have a theta of 4 cents. When should those options be worthless? They should be completely worthless by the end of the week, correct?
Absolutely.
Yeah, and yet they're not. What's happened? Does anybody have a good answer? Theta decay is nonlinear. But most people assume theta decay is exponential, right? And what causes the nonlinearity in theta on these out-of-the-money options? All right, well, I'm going to answer that for you. All right. Being short worthless options is a margin pig for market makers. So there are two ways we're margined as market makers. One is risk, and two is there's actually a minimum margin requirement per contract of 25 bucks. So each put that I own costs me 25 bucks of margin. What is the value of the 101 put? $2. And it's margined at 25 bucks. How's that? You think I want to be margined 25 bucks on a $2 option? No. No, I do not. Right. So one, market makers don't want the leverage, and then two, market makers have this risk control. At a certain level, it's because on top of the fact that from a margin standpoint, it's not worth it to sell it to you. All right. From a risk standpoint, it does not pay off for my career to be short this part of the complex. You know, I can tell you a couple of stories where I covered puts for 5 and 10 cents that became worth $20. All right? I mean, look at what happened in August. All right? I mean, look at the beginning of the week. So let me pull up live vol. This is what I actually used to trade. Thinkorswim is garbage. So let's look at like right here. Oh, it was the 21st. Okay. Let me just go to kind of when volatility had kind of fall off. So here we are. IB30 is 11. All right, volatility is around 11. All right, and the AUG21 2000 puts are 30 cents, and the 1975s are 20. And even if we go the next week out, the 1900 puts are 25 cents. You know, all of these options are worthless. I don't want to be short any of this garbage. All right, in the 2000 puts, expiring the following week, are worth the equivalent in a $200 stock of about 10 cents. From a margin perspective, you know, at least in SPX, the margining is a little better, right? I'm short at $1, that's 100 bucks against 25 bucks a margin. But, you know, all the stuff down here, you know, it stays bid forever. because nobody wants to be shorted. So at a certain point, it stops being worth having these positions on. And if you think about it, I'm assuming most of the room is premium sellers.
Yeah, I would agree with that.
All right. If you are a premium seller and you're not covering, the time where options make the most money is when they go from being something that is reasonably could take place to when they become unreasonable. All right. I call it the cone of feasibility. All right. So, when you ask yourself a question, all right, so IBM, could it trade $200 by Friday? No. Could it trade $200 by 2 Fridays from now? No. Could it trade $200 by January? Probably not. Could it trade $200 by, next June? Probably. All right, so that's really how options kind of decay. As they become less and less likely to occur, they lose value. All right, and that process of going to could happen to not going to happen is a major piece of where the decay comes out. But after an option goes, well, it's probably not going to happen, if it retains value, which they often do, it's going to take until the final day of trading to make your money back or to recoup those dollars. So you are tying up in, let's just say that I'm some put spread seller. I'm a condor seller, and I've got on a 1950, 1940 iron condor that would cost me 5 cents to unwind, and I don't want to do it because I don't want to pay the commission, which is the excuse I get a lot, or I don't want to pay the nickel, which is the excuse I get a lot. And look at how much money you threw out the window because you were going to wait an entire 5 days, or an entire 2 weeks to collect a nickel. It just doesn't make any sense. You're trying to make a nickel in 2 weeks when the capital tied up between this put spread, every one lot between the 1950, 1940 put spread costs is going to be $995 of margin, $1,000 of margin to make $5. That stuff needs to be covered because 1, it decays way slower, and 2, it decays. It eats up margin. So the first key to understanding units is cover them, cover them, cover them. If you are short an option and it has entered unit territory, it's time to close. Not a long, leave the longs on, that's fine, but cover your shorts because they're not worth it. Too much margin, too much risk. All right? Now, so does that kind of make sense to people? Yeah, so that always, it could, is what makes these retain value. The Greeks are only theoretical numbers. They may not correspond to reality. That's exactly right. And actually, at the outskirts, the model falls apart. It stops breaking, or it breaks. It doesn't work there. Options that are 5 delta and below and 5 delta and above are borderline impossible to model. Garbage in, garbage out. It stops being a volatility and starts being about a price. And market makers don't want to sell those. All right, now, since my last book, I've become less of a big buyer of just random puts. All right, I do hedging activities, but I've done a lot of research into VIX. All right, and anybody here trade VIX?
I think there's some that do.
I'm launching a hedge fund in October that only trades VIX. It's like my favorite product. Well, one of the things that we've learned is that over time, the VIX futures curve is the best predictor of bad things for the market. All right, and it's not worth hedging. It really isn't worth hedging in mass option positions most of the time, and really a lot of stock positions most of the time. All right, so you can do that. You can do that with some sort of long hedge position, but the hedging costs associated with hedging using your 2-year options or whatever cannot work. All right, it can cause all sorts of problems. I spent a year working for a fund, and the more they'll remain nameless, but they were a defined risk strategy is what they is, and they hedged all the time. All right, yeah. Yeah, Andrew, I'll answer that when I'm kind of done with this discussion. So, I spent some time and really looked at the hedging costs, and the costs associated with being really secure were greater than generally the losses that they hedged off over the life of the hedge. So then we looked at, when you look at the VIX futures curve, though, that changes. If all you did was go to cash or short S&P futures against the S&P when VIX futures go backward, the market would, you would add about 1,500 S&P points since 2004. The results are astounding. Since 2004, the S&P is up about 800 some odd points, I believe. You would be up about, I want to say you'd be up, well, I'll tell you. I've got let me get the Excel out. Where did I put that? So really, give me a minute here. No, this is not it. Well, I do have it on. I've got a picture of it on the blog. I was going to pull up the actual Excel and give you a straight number, but apparently not today. There you go. So you, as opposed to being about 2,000, you'd be at about 2,800. So you pick up about an extra 800 or 900 points. You would have been out of the market this entire time. You would have gotten out of the market on the middle of the morning on Thursday. So you would have avoided most of Thursday, all of Friday, all of Monday, and you'd still be out of the market. So you'd have saved yourself at this point about $80 already. You would have gotten in probably today. All right. So the point is, I actually prefer to let the VIX tell me when to hedge. So now that VIX is October is below November, is below December, I am looking at the market and saying it's now probably a decent time to get in and be short volatility. All right, and be short to be short options. I also think it's probably time to get back in the market. I'd rather buy here than 80 points ago and be sure. All right, now, when you stay out of the market when VIX futures are in backwardation, do you mean you just front month versus no? I mean you need more than two, really, when M2 breaks M3, that's the clear sign. If M1 has a lot of time like it did this time, then absolutely that's fine. But if you see VIX over M1 over M2, and M1 has more than 20 days to expire, then the answer is yes. But if M1 just has a week, then you need M2 and M3. Does that make sense? I'm going to get some more ice. Give me a second, and water. Your mom's not there yet. Your mom's finishing about half an hour, okay? Well, your mom's not there. She's doing carpal tunnel. So you want to go outside? So, all right. M standing for month, yes. 1 second, folks. All right. So, Mark, you do something to entertain her, okay? So that's kind of how I look at units and hedging now. Now, that being said, the way I'm structuring my portfolios is entirely different. Typically the way I build a portfolio, I don't need units, and it's because I'm building a portfolio that is long premium, but also long defined risk. So imagine a scenario where, so a trade I'm going to do, I would typically do this in multiple assets to create this. But imagine a scenario where I find a straddle that I think is way too cheap. All right, and I buy it. And then on the other side, I find a butterfly that I think is too expensive and I sell it. That's kind of how I build my portfolios now. So it ends up looking something like this. I'm just going to create a couple of trades here that we can look at. All right, so here's a butterfly, and I say, okay, this butterfly is way overpriced. Then in another product, let's say I'm looking at Russell, I say, Russell implied volatility is really cheap relative to the SPX. So I go in and I buy a 60 straddle, like 1 or 2. All right, well now when I put those two together, all right, when we look at those from a risk standpoint, come on, I end up with something that looks like this, that's collecting carry, but has a much smoother, look at the vega on that, almost none. And it's got a little bit of delta, but not much. And if the market blows up, I'm going to be fine. Because I actually eventually start to get, you go from kind of short vega to long vega. So, like, if we went back down to 1870, all right, and then we jack up volatility, on both ends, lifted by 10, I'm in good shape. Yes. All right, and so this is kind of like how we build portfolios. We actually look for inexpensive things. So let's, in this case, I'm using RUT, but, we try and find a really cheap things to buy, and we try and find really expensive things to sell, and then we build a portfolio with that collects carry, but can kind of make money. Now, if we do everything right, we can make money twice, right? So imagine that instead of being RUT, this straddle is in Goldman Sachs. All right, and then I've got this big SPX butterfly, the SPX chops, but Goldman is a big mover. Goldman is a big mover, and that straddle wins. I can win twice with my own hedge. How do I find it expensive? Based on IVR of each index. What is IVR? Is what? Implied volatility. I do not use an implied volatility ranker. I use the charts I use. I'll look at a chart that looks like this. And what I'm looking at is, I'm looking at where the implied volatility is, where the realized volatility is, what the intraday movement has been, and I'm kind of developing an opinion based on how, on the story of the underlying and where its volatility is priced and where it's been priced historically. So maybe I unknowingly use an IVR, an implied volatility ranker, but I don't just look at expensive because things can be expensive for a reason and things can be cheap for a reason. And so I will sit there and, I'll sit there and kind of just look, and you look at things long enough, you just kind of know, but that's what we kind of try and teach our students to do, is to understand, why is volatility high, and how much is the underlying moving, and based on what we know, does it all kind of come together? Tom, I don't think we may not even get to reverse Harveys today. And really, reverse Harveys, the reason why we do reverse Harveys is the same reason why we cover units. It all goes back to risk management. When, when those outer wings stop helping, it's time to move them, right? So when a hedge no longer hedges, it's time to move, right? Now, so do you scalp the straddle trade, or do you just leave them alone? We'll scalp. I'll definitely scalp gamma. Absolutely. Not with stocks, usually with options.
Hey, Mark, I remember way back in the option 911 days, you wrote an article on units, and I remember you had 3 points that you're either right, you're wrong, or you're really wrong.
Yeah. Yeah. And that's just it, is, you don't want to be really wrong. It's okay to be wrong. And so the idea is, I think it always makes sense to be net long options, all right? Not net short options, but it also makes sense to do it smarter. And so I've moved away from just owning cheap out of the money stuff and into this idea of trying to get long options for edge. So I want options. I want to own options that I think are going to go up in value, and I want to be short options that are going to decay away. And that is how I structure portfolios. That is how we do everything at Option Pit. And really, that's kind of what we're looking at. And that's kind of how I think about trading reverse Harveys as well, is just moving things around. All right, so here's another piece that actually was kind of interesting via the, and then I'll stop and I'll just field questions. one thing I like doing is, in terms of hedging, is I like VIX so much more than I used to, especially now that I know how to kind of do it strategically. So if I look at a backward market where futures are now in backwardation, I'm a big proponent of using either a long VIX futures strategy or a long VXX strategy rather than even hedging the S&P, because if I'm hedging my portfolio with VIX, I can allow the S&P to rally while I still have on this big crisis volatility hedge, and can actually theoretically make money twice. If you look at VXX, all right, so here's VXX, but I just want to look at the 3 month, and actually I want to look at let's just look at August, and then I'm going to add a chart of returns of SPY. All right, so check this out. In the last month, you'd be down about 5.8%, but your hedge, you basically get long here. All right, so you end up getting in at about, let's just use the bad closing price, the high of the day, 2073. And even with the vicious move that we've had, you're up, if you didn't get out when things went backward, if you got out till close day, which would have been terrible, you're up $3.50 on the trade. If you were smart, you probably got out around 24.5. 4.5, so you made $4.50. Well, let's just say $4. So you made 25% on your VXX while allowing the S&P to recover from down 11 to up about 5. So because the volatility actually does hedge, but it hedges in a different way, and it can stay stiff. I mean, look at this. The VIX has stayed above 20, and we're 100 points off the high. I like using VXX or VIX futures as my hedge rather than going a S&P futures or puts. Now, the other reason why I like this approach. So let's look at a SPY chart from last year, or last year's fine. I use all kinds of variations, Ron. I mean, I may have on a back spread, I may have on, you name it. All right. Let's just look at a chart here, and let's talk about hedging in 2014. All right, so I'm going to bring it back down to we're just going to look at 2014. All right, and let's take a look at what we got here. All right, so let's say I hedged early on with SPY 184, 185. I went into let's just use, we can just say the Jan 2015s, or we can use the Dece 2015s. Or we'll use the Jans. Let's do Dece. That's fine. Here we are at the Dece 2015s. And let's just say I did a hedge, and I hedged a reasonable rate. I hedged the 165 put. I paid $11.40 for it. So let's look at now the Dece 165 puts. They're not doing anything for you. The markets ran up. The SPY's only $2 away from where it started, 20 points. And my puts lose money. So, the point is that if I look at the same period, here's the beauty of using VIX or something along those lines. So if we look at VIX on a chart, I'm going to use that same time period. All right, so, I'm going to have to, I don't think, we could even look at like, I don't know. I don't think I get October, do I? No. All right, so I'm going to have to move a little forward. I'll find an expensive time all right, so we'll do like right here. All right, so here we are. VIX is, even if I had to when the VIX is 16, and I go out and I buy, a January option. I mean, this is the Januaries that expired on the 15th. These are the Januaries that expired Jan 2015. So they're $3. The Jan 17 calls. If I want to go way out of the money, I can get a 30 call for $1. Well, the smart person does the Jan 18 30 call spread for $2. But let's just say we buy the Jan 18 calls for $3. Well, the beauty of it, so here's the VIX at 26 at that low again. And you can see my hedge actually works. And that's because the VIX has a lower bound. So you can't run too far away from your hedge. And that's the key. So that's kind of, so with that, I'll just I'll field questions. I'm here to answer questions.
Oh, I don't know if you have time, just a lot of people don't know Dan Harvey. By the way, I'm seeing him in Paris in 2 days. So
yeah.
But maybe you could just explain what a reverse Harvey is for those who don't know it.
So a reverse Harvey is a trade. So that's sure, very simple. So here's this butterfly on, all right, and I move my days forward, and I'm sitting pretty, right? I'm up $4 grand. But what's the problem? My risk still is, I still have all this risk. So what if I execute a trade that looks like this? A second here. And I'll go into detail next time I'm here, Tom.
No problem.
All right. So, but what if, after time passes, I do a trade that looks like this. All right. All right. Now, so take $1 out of it. So H. And just get the price. There we go. All right. So let's just look at what we do to our risk here. So here's the trade. So what if I sell out my 230 call and buy a 210 call? And I sell out my 1930 put and I buy a, whoops. There we go. Something screwed up there. Oh, it's 20. Duh. Oh, that was right. I'm sorry. But what's wrong? Oh, no, that's all right, right? No. I want this to be 1930 and this to be 1950. I'm sorry. There we go. All right. Now I can show you. All right, so take a look at this. So I'm up $4,000 on my trade, but I'm saying, I still don't think the S&P is going to move, and I want to make more money. Well, if I sell out my 1930 put and buy the 1950, and then I sell out my 2030 and buy the 2010, I can take a ton of risk off, really smooth out my gamma, still keep some decay, still play this thing to sit. You can see how the trade actually does collect dollars if the underlying sits, and I've taken a lot of risk off the table. So this is, again, trying to manage risk and collect dollars. Yeah, I know, I moved the date forward on purpose. I wanted to show making money.
And then maybe if you bring up VIX Central, you can see a graphic of the VIX futures.
Mm-hmm.
And then comment on Ron's question on the current VIX futures where the M1...
No, so, yeah, I actually think it's probably time to not be hedged and to potentially go long the market. So are you recommending to use VIX to hedge short Vega positions like HPAC and Jeep instead of having extra cheap puts? Well, what I would say is, I'm not saying that at all. What I'm saying is, you find, against HPAC and Jeep, find I don't know either of those, what the reason would be to be in those, but what I would say is that find something else that you want to own to be long, that maybe is related or is unrelated. Find a cheap option to buy, or a cheap straddle. Well, he knows he's not supposed to bug me when I'm on a presentation, and he's doing it today, which is naughty.
Well, I think most of us have had kids that age, so...
Yeah. So.
Fortunately, my youngest is turning 23, so those years are behind.
Oh, geez. Yeah. All right.
I don't have any more questions.
Cool. Well, I'm happy to go over anything else, but I for not being prepared, for just kind of expecting a question and answer, I went off on a nice 50-minute tangent there, didn't I?
That's okay. I mean, it's a good topic. So,
yeah.
With the movement in the VIX futures and the backwardation with this big market move recently is a good speaking opportunity with some good points to go over.
Yeah, well, and that's key. VIX is the best. Nothing predicts the market better than the VIX futures curve. It is by far the strongest long-term indicator.
And then long-term...
Oh, yeah, I've got a webinar on Saturday, and I'm going to go through this in probably more detail. Obviously, that one I will have slides for. I'm going to go through really how to build a money manager plan, a trade plan, how to do some basic adjustments, and how to manage risk and some risk management pieces. Let me drop the link in there for you guys. So I would encourage you guys to sign up. I'll send a copy, recorded copy, if you can't catch it. So that's going to be about an hour and a half. Any other questions?
I don't think so. Andrew was just asking about your webinar on Saturday, but I guess
Yep.
you're talking about it now.
I dropped the link in. So I dropped the link in the chat box, and I hope to see some of you guys there. We're going to dig into a lot of it's going to be some of this in more detail and more concise. Let's just say.
Fantastic. All right, Mark.
Awesome.
Well, really great to have you and to reconnect.
Yeah.
Let's do it again in the near future.
I can't wait. I heard you once say that VIX cash is above VIX future. That means the market is under stress, which is the case now. Yeah, the market's still not completely right, but the VIX futures curve is far more predictive than cash to future one. All right. Well, I appreciate you having me, Tom, and I will let you guys go, and thank you very much.
Okay, thanks again, Mark. Thanks, everyone.
Have a good day.
See ya. All right. Bye.